You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey guys, welcome back to another episode of Market Champions. Today we've got Andreas Steno Larsen from Nordea. He's the chief strategist at Nordea, focusing on the G10. Thank you so much for being on the podcast.
Thank you for having me.
So I first wanted to start off with your background, how you got into finance and your journey to where you are today.
Well, I've actually been at Nordea for roughly 10 years now. And in Denmark, where I'm from, it's pretty common to take a job while you're studying. So I actually started at the trading floor in Nordea already while I was doing my bachelor. And then I also decided to go ahead and take the master. So I've actually been on the trading floor in Nordea also while I was studying, which is a pretty common thing in Denmark. And I've been there basically ever since, moving my way up the ladder within the research organization. And now I'm the chief strategist today.
Awesome. So I first wanted to start off by talking about sort of your views for 2021 and beyond in terms of growth and reflation. So where do you stand on sort of the reflation narrative? Do you believe it's real? Do you agree with Jerome Powell when he says inflation is transitory? And what are you watching for right now?
Well, we are recording just after the FOMC meeting, and it was pretty clear that Jay Powell kept his view on inflation intact, that it's just driven by bottlenecks. That was a new word on the press conference today, and base effects from commodities, basically. I don't agree with his view. I think inflation will prove to be much stickier. And I think we've seen a couple of inflationary game changers over the past year or so. The most important one being the direct transfers that the Trump administration launched back in Q2 last year. To me, that's a clear inflationary game changer, as it puts workers in a much better spot negotiation-wise versus employers than what they've been in over the past several decades. I actually think for now there is actually a chance for once that workers will be able to increase wages already this early in the rebound, which is quite remarkable. And the interesting thing here is that the Fed is not on top of this. And secondly, they are not on top of the what I would say called the political analysis of this, or the political repercussions of this. When you launch a measure such as direct transfers, it's very, very tricky to get rid of it again in a democracy. So I would consider direct transfers, or maybe even a universal basic income, as the new normal.
Do you have sort of any thoughts that, basically the other side tends to say that, okay, so all this money's gone into the hands of the public, but then they tend to point to the velocity of money all going all the way down. So do you think sort of the reopening and the vaccinations is sort of going to force all the money that's in the hands of consumers into the real economy?
Well, that's certainly my assumption going into the spring and early summer here. I don't think it's a surprise that velocity is down when you've printed so much money. I mean, it's kind of natural, and it's basically just the nature of the equation. But anyhow, when we get the reopening fully in place, I would expect velocity to rebound quite swiftly, and that should prove to be inflationary in itself.
Mm-hmm. And the Eurodollar futures, which are the interest rate futures, are pricing a hike in towards the end of 2022, early 2023. Do you think that it's going to be earlier than that, or do you think that we might see the Fed hike later than that?
I still lean towards earlier than that. I know it sounds awfully optimistic, but if we just extrapolate the trend from the most recent job report in March. We had almost 1 million new jobs created in March. Then we will actually be back at full employment before the end of the year if we get similar reports each and every month from now. I don't think that's out of scope. I actually find it quite likely. If you look at, for example, the NFIB survey, then respondents tell us that it's record tricky to get job openings filled. And I consider that a signal that the labor market is running much harder than anticipated.
Got it. And what are your views on sort of the taper tantrum, and what do you think the consequences could be if we see the announcement of tapering, this summer?
Well, it will be a huge surprise to everybody if they announce it already in June. They've been very clear that they want a pause between the announcement and the actual tapering. That's obviously fair given the historical lessons learned. But I think the first step is just to acknowledge that a tapering debate needs to be taken at some point. And they're not going to do that outside of meetings, I don't think so. So in that sense, June is maybe a likely occasion to just acknowledge that a tapering debate can occur in a point in time. And then I expect them to actually proxy follow what Bank of Canada has done. I know you follow that as well. I call that outcome-based tapering. I think it's a very smart way of doing it. You can simply just communicate if we reach this threshold in terms of unemployment, then we are ready to do this amount of tapering, and it actually guides the market in a smart way. And then I think you can do a tapering process without harming markets too much.
Right. Are you still sort of bullish, U.S. Treasury yields and the dollar, medium to long term, especially with your outlook that we might see inflation go higher? So are you bullish on U.S. Treasury yields also heading higher?
Well, yes, I am, and I think what we've seen, and now I use the same word as Jay Powell, but what we've seen over the past month or so are transitory drivers of long bond yields lower. We've seen a clear pickup in Japanese bond buying due to the kickoff of the fiscal year in Japan. That's very clear from the data. We've also seen banks issuing long-term bonds and swapping them back to floating rates. So that's another transitory driver. And given my view of a very inflationary summer and a strong labor market, then I would, of course, argue that rates need to be higher than they are right now. Target-wise, at least 2% of the 10-year Treasury yield already within the next 3 to 4 months.
And what are the risks to the thesis that you've sort of laid out of seeing higher inflation, higher, more structural kind of inflation as opposed to transitory inflation?
I think Powell put it in a great way at the press conference today. He basically told us that they expect a lot of people to return to the labor force once the pandemic is actually truly over. Mm-hmm. And they probably survey-based, they find a conclusion that a lot of people don't feel safe at going to work still. So there's clearly a risk that I underestimate this effect, that there are more people waiting outside of the labor market, ready to rejoin as soon as it feels safe. In that case, I could be wrong that labor markets will return to full strength that early. And it's of course debatable how much of this effect, whether it's transitory or not, and whether people will return in size earlier than anticipated.
And do you believe that the inflation that you believe is coming, do you think that's going to be more secular, sort of over the next decade, or do you think it's going to be more short term over the next few years while the money that's in the hands of consumers just gets doled out, and then after that it's going to die down?
I actually think that we will get inflation printing above recent decade averages over the next decade. I'm not going to say that it's going to be a crazy inflationary environment, but we're going to print markedly above the average that we've seen over the past decades. And I think the reason is that we've had a paradigm shift in terms of fiscal policy, not least given the direct transfers and the scope for universal basic income. And then we also have a clear move in relation to the academic debate on the topic. MMT-like policies are getting more and more sought after in academic circles, and I clearly see that as a trend rather than just a glimpse. So yeah, inflationary bullish over the next decade, and maybe as much as 0.5 to 0.75 percentage points higher on average.
As you mentioned, fiscal. What's your take on this new Biden, infrastructure plan or new infrastructure bill that he's trying to get into law? So what's your take?
Well, what we know about infrastructure bills is that it always takes a whole lot longer to implement such bills than what they expect on forehand. You don't just go ahead and build a bridge. There's a long planning phase, and politicians tend to underestimate the length of it. So this is something that will probably carry spillovers at least into 2022 and maybe also 2023. I doubt that we will have a big fiscal effect out of it already this year.
Got it. Another thing that you've tweeted about is you've talked about the global manufacturing cycle, and you're saying that it looks sort of peakish. So could you explain, why you've taken that view, and how someone would actually go about trading it? And that's obviously not financial advice, but just wanted to get your thoughts on it.
Yeah, sure. I mean, the manufacturing cycle is clearly linked to China, and if we look over the past 7 or 8 years, China has been the key driver of manufacturing, and therefore, when I watch Chinese credit growth right now, I get the feeling that we are very close to peakish levels in terms of the manufacturing momentum. Obviously, we will get a transitory tailwind from a reopening, but it matters more to the service sector than it does to the manufacturing sector. And the manufacturing sector is clearly more interest rate sensitive than the service sector is. Why we have this pattern that when interest rates go up, you tend to see a slowdown in manufacturing activity over the course of the next 12 to 18 months. And basically, we are entering that period of time. We've seen interest rates going up for 9 or maybe even 12 months in a row now. And therefore, within 6-9 months from now, you should expect manufacturing activity to wane. But the point here is that the way you trade it would usually be via commodities. There's a risk this time that commodities will be used as a hedge against this inflationary environment that I fear. But otherwise, the easiest way to implement a trade on a manufacturing cycle that slows would be via shorts in the copper.
Could you say the last bit again?
It would be via shorts in copper.
Okay, got it.
Yeah.
And what are sort of the implications for China specifically? Are you sort of bearish on China since you're bearish on the global manufacturing cycle?
Well, yeah, from a momentum perspective, clearly, I already think they are running above trend growth, and it's not visible in data yet since we have outdated data from China. But the stuff that we can actually track looks clearly above trend already, and therefore, from a momentum perspective, clearly they will see slowing momentum into the second half of the year. But China is on top of the development economically, and they have the toolbox fully equipped still, which is not something that you could say about the West to the same extent. Got
it. And I wanted to move from China all the way to Sweden, and you sort of shared your thoughts on the Swedish housing market, and you've pointed out that the Riksbank keeps buying covered bonds. So could you explain, what exactly is going on and what the implications are? Well, the Swedish Riksbank has bought a lot of Swedish government bonds over the past years, now to the extent that they own more than half of the market, and in some parts of the yield curve, they own almost 2/3 of the curve. So they had to look for other assets to buy when the crisis hit in 2020. So they found out that the mortgage market is much bigger in size. It's basically to take it top down. The Scandinavian economies are not particularly indebted
indebted by via the government, but they are indebted via households. So the household market is basically much bigger debt-wise, and therefore they've started buying covered bonds, which are essentially the bonds backing the mortgages. And well, the consequence is pretty clear. You see a smoking hot property market in, for example, the capital of Stockholm, and to me, it's kind of unwise to keep buying covered bonds to that extent while house prices is just exploding. Why don't you just step on the brake? I don't really get it. Yeah.
And what are your views on sort of the USD and Swedish kroner?
Yeah, I mean, if you look at US dollar versus Swedish kroner, then it's kind of a proxy trade of euro versus dollar. So the Swedish krona is what I call a high beta currency to the euro. When there's performance in the euro area, then Sweden performs times 1.5 or so.
Mm-hmm.
And therefore, currently, we've seen that the euro area picked up pace a little bit here in April, which has led dollar versus Swedish kroner lower. But I still find it very likely that we will see a move higher in dollar versus Swedish kronas, not least due to the fact that the Swedish central bank is maybe the most dovish of the G10 central banks. I even consider them more dovish than Bank of Japan into a rebound like the current. They are very, very inflation focused. We know that the Swedish krona has gained strength over the past year, so the inflation will not show up in Sweden as it will elsewhere. So that's one reason to remain negative on the Swedish krona. The other part of the equation is that the Fed still underestimates the roaring comeback that we will see in the US this year, which could lead the dollar in a stronger direction, I guess.
And when sort of the economic data in the US is pretty strong, so why does the DXY, the dollar index, keep going lower and lower?
Yeah, I mean, usually I think there's a lag between a fiscal response and the actual market repercussion.
Mm-hmm.
So what we saw in Q2 last year was a scarcity of dollars. The Fed took action and printed enough dollars to end the scarcity. But now the next move is obviously to price in the slowing momentum of dollar liquidity that will be coming up if the Fed starts tapering. And currently, no one dares to bet on a tapering process anytime soon. So that would be sort of my trigger move for a rebound in the dollar. I still think that the dollar is in a weak spot as long as the Fed keeps printing at the current pace. I have to admit that, since the double deficit of the US is just remarkable, and it's much bigger than all peers in even measured as a percent of GDP. So the Fed will have to underpin the dollar. Otherwise, I will be wrong in my view. That's clearly the case.
Got it. And coming back to the topic of the Fed, today you in a tweet you pointed out, and I quote, "The Fed still looks for actual substantial progress and not forecasted substantial progress." And then you pointed out that we will look for clues at the presser while also watching for IOER, the interest and excess reserves clues. So could you go more into that? Number one, what clues you're actually looking for?
Well, it would have been interesting if Powell actually said that they had a specific target in mind.
Mm-hmm.
If he hinted that the NIRU, so the non-accelerating unemployment rate, had a specific target. We know that they've had research on the topic before, but we don't know the exact target. That could have been one hint, but otherwise, of course, I looked for clues on whether the Fed was already now discussing if inflation overshooting target had a specific threshold as well, and they are frankly very far from having those targets, at least publicly. So it was kind of a disappointment in that sense. We're not any wiser on the topic than we were before the press conference, to be honest.
Right, got it. And have central banks sort of already used up all their ammo? And you were talking about the Fed and the rate at which they're doing QE, that's already very high. So have they sort of already used up a lot of, or almost all their ammo? And what can they do in an economic downturn?
I guess the reason why we have such a focus on fiscal policy right now is that the central banks admit that they are at least running out of ammo. But to the extent that you just decide to finance new issuances of bonds from the government, then I actually think that you can basically increase balance sheets to an extent that we don't know the size of yet. What we saw in Q2 last year was basically just a remarkable transfer of money from the Federal Reserve balance sheet to the U.S. Treasury general account, and I guess you could resume that experiment over and over and over, at least until inflation puts an end to it. I think the threshold here, or the caveat, would be inflation, just as the MMT supporters say. I know this is not actual MMT, but it resembles MMT practically, I think, at least what happened in parts of 2020.
Got it. And what are sort of the longer term implications of what you've just mentioned with all the fiscal and with all the printing that the Federal Reserve is doing? So what are sort of the long term implications? Do you believe that eventually tax rates are going to have to go up? They were talking about a higher capital gains tax rate, for example. So what are the longer term implications of what's going on right now?
I think tax rates will have to go up. I consider it inevitable. And I also think that the millennial generation will vote for politicians wanting to hike taxes, since it's the only way to create a wealth transfer from the generation that have enjoyed the ride on asset prices. If you're not a part of a family that has actually enjoyed that ride. So I consider it inevitable in a democracy that the generation that will now become the most important one will have to vote for higher taxes. We are already seeing it with the Biden administration. They're talking about it. They're not implementing it yet, but it will slowly but surely be implemented over the coming years. I consider it inevitable.
Do you also think that asset prices as they are right now, especially when you look at the stock market, do you personally consider it to be sort of a bubble? And if so, what is it going to take to actually pop it?
Well, and that's always the $1 million question, right? and I guess there are signs of a bubble. It always scares me when you see a lot of margin events. We've seen that over the course of the spring here. We have seen a big acceleration in margin debt from the autumn of last year and into the first quarter of this year. And it has actually started to slow after the events we've had with hedge funds blowing up and family offices blowing up, etc. So yes, there are clear bubble signals. The issue is that as long as we have as much liquidity as we have in the system right now, there is nowhere else to go than assets. So I think the only risk to asset prices is central banks pulling the rug from under the liquidity situation in a fairly aggressive way. We would need to see some sort of aggressive tapering for the Fed for a complete meltdown in asset prices to occur. And I'm not sure it's just around the corner. I would rather argue that we have flattish developments in sight for equities over summer, not something fairly dramatic.
Right. Do you think there are any catalysts for central banks to pull the plug, especially when they're sort of talking about letting inflation run hot? So even if inflation goes higher, they're probably not going to pull the rug. So what is going to cause these central banks to finally pull the rug from and start decreasing liquidity in the market?
Yeah, I mean, if they don't care about inflation going clearly above target, then the only old school explanation to start withdrawing liquidity would be if employment goes above its natural level. That's basically also what Jay Powell kept referring to today, that he didn't really believe in any inflationary pressure until employment was large enough. I think that's an old school way of viewing it, but apparently the Fed is still in that kind of school of thinking when it comes to inflation, at least.
Mm-hmm.
So that would be, at least it seems as if as long as Jay Powell is in charge, that could occur. Otherwise, the risk is fairly low of them pulling the rug from under the liquidity outlook. I have to admit that, because I mean, every time there's been a small setback to the liquidity outlook, then we have them back buying within a quarter or so, right?
Mm-hmm. Right. And are there any views that you have that we haven't touched upon so far that you would like to share?
Well, I think if you look at what's the optimal hedge that you can do against the view I have over the next decade. I'm not a tactical fan of gold right now, but it's, to me, an instrumental part of a portfolio heading into this kind of environment, since it is the only natural inflation hedge you have around. If you're not practically able to trade inflation derivatives, for example. So gold is still a top pick. I'm not saying that you should put all your money in it, but have it as a part of your portfolio in this kind of environment that I depict. That makes a whole lot of sense.
Mm-hmm. Got it. So, moving on, I wanted to talk a little bit about the process that you use. So, what do you think are the most important leading indicators, especially for FX pairs like the euro?
Yeah, I mean, when I look at FX, you of course need to look at things in a relative perspective. So you need to watch both sides of the coin, and I prefer to look at relative liquidity as the best leading indicator.
Mm-hmm.
So basically what I do is that I try to forecast the liquidity developments in the US and in the euro area, but I also look at lead lag patterns between relative liquidity and euro dollar, for example. You do find a lead time. It's not as clear as it was a few years back when fewer people watched liquidity developments. It is now sort of a hot topic for more or less every analyst, but it is still a good leading indicator when you watch relative liquidity as a percentage of GDP or as a percentage of market sizes. So I guess that has to be the top pick. The other interesting leading indicator would, in my view, be to watch what I call relative credit growth.
Mm-hmm.
So relative M2 could be one way of measuring it, but if you have even better leading indicators for credit growth, it could be lending surveys. Then they are also very interesting to watch when trying to grasp FX developments.
Right. And, going back to the first leading indicator that you mentioned, when you talk about liquidity, is that purely focused on sort of, the monetary aggregate? So talking about,
Yeah.
measures and so on.
Yeah. When I talk about liquidity, I only talk about what I call digital reserves. So reserves that are ultimately parked at the central bank. And those are publicly available. So you can find them usually at the central bank's own webpage. Yeah, and when I talk about M2, that's obviously a broader measure of money.
Mm-hmm. Right. And how useful are interest rate differentials and growth differentials for trading FX?
I don't consider them particularly useful in terms of leading capabilities. If anything, then I would watch growth expectations instead of actual growth. So we have an interesting chart that we've used a lot in recent weeks with the massive differential in expectations between US growth and growth in the rest of the world. You've never had such a discrepancy in annual growth rates. I guess that could be a signal to buy the dollar. At least we've used that argument. But otherwise, I would consider them coincidental indicators, so they move at the same time. If anything, you would probably historically argue that interest rates tend to lead FX, but I don't find that particularly convincing when I study lead lag patterns now.
Right, got it. Do you have any views on sort of our market regimes and how different assets perform in market regimes. So how do you think about sort of the regime shifts, especially in the leading indicators that you mentioned?
Well, I mean, if we're headed towards an inflationary environment with truckloads of liquidity, then I would suppose that fixed income will play a less important part of the portfolio than what is done historically. At least if we assume that central banks will not allow nominal bond yields to go up alongside the inflation pressure. That's at least what we're seeing right now, that they compress bond yields even with an inflationary pressure, right? Fixed income is kind of dead in that environment. And what we've seen also when I discuss this with big institutional clients is that there's a tendency for FX to become sort of, or when I would say that FX is actually reborn in this kind of environment, since it is a way to find risk premiums, for example, via carry strategies or via optionality strategies. And in a dynamic, systematic way, you can still actually gather risk premiums in FX, which will be very tricky in fixed income if central banks keep compressing interest rates, even if inflation runs on.
Got it. What is your process for idea generation? So how do you go about actually generating an idea before deciding to go on it into further depth?
Well, I always look at relative liquidity if we talk FX. Then I try to assess leading indicators for the economy in both of the underlying countries. And for that, I usually use interest rate and market-based prediction models for the economic momentum. So if you, for example, take the US ISM index, then I use interest rates 12 to 18 months earlier to predict where it's headed. And you can basically create similar models for the regions. Then you have relative liquidity, relative growth. You probably also need to try to predict relative inflation. And then you actually have a pretty good framework. We have what we call the dollar barometer, where we look at relative liquidity, relative inflation, relative growth outlook, and then the final, which is more subjective, I would say, is the relative policy outlook. And by policy, I don't mean fiscal policy. I actually mean sort of the broader policy risk premium. And one example of that could be Trump inaugurating a trade war. That's difficult to pinpoint via a time series, right? You simply need to do a political analysis. But if you have all factors pointing towards the same direction, then I consider it a strong buy signal.
Got it. How do you go about actually expressing, trade ideas? Do you focus on, how do you go about expressing these trade ideas?
Well, I mean, since I'm a sell side guy, then I would obviously need to cater for the needs of my clients. But what you usually see in big institutions is that they, of course, use leverage in a smart way. So if they find a risk premium that they like, then they tend to leverage it. And then you would usually also find many institutions hedging themselves against being wrong on the direction. So risk premiums are really what people are looking for, rather than directional bets. At least when we're talking classical institutions such as pension funds and asset managers, outside of being just perma-long as they need to be. But when we're talking about hedge funds, they can obviously express themselves in all sorts of ways, both long, short, whatever asset class, whatever instrument. And there you tend to see more exotic solutions than what I just mentioned. So there's a wide range of it, but usually the most classic way of expressing a view would be via finding a risk premium. It could be a relative spread, leveraging it, and then hedging against the directional risk.
Got it. Are any indicators or asset classes in different market regimes right now? And what risks are not priced into what's going on in the markets today?
Well, I don't think that markets have priced in a decade-long inflationary environment. Otherwise, gold would have traded much higher. Some would argue that the crypto move reflects this inflationary environment that is coming up. I mean, what's needed for a population to hold the local currency is basically that you get a return when there's inflation. And currently, I think people are scared of that not being the case, which is probably why stuff like crypto is booming. So you could argue that's at least some asset classes reflected, but I would argue that precious metals are not reflecting it. Otherwise, I would probably also argue that everyone and their mother is turbo long equities into this kind of environment. I get why you want to have a lot of equities in your portfolio. I just tend to think that people overweigh them too much into this kind of environment, since you will have to have classic inflation hedges implemented in your portfolio, if I'm right.
Got it. Any closing thoughts?
No, I just look forward to Jay Powell and the Fed actually being willing to speak about their their future plans. I mean, it was having just watched the press conference. It was one of the most boring press conferences I've ever seen from the Federal Reserve. So hopefully they bring about more news into the summer, so we actually have some trends to trade.
Absolutely. Thank you so much for being on the podcast. It was awesome having you.
It was a pleasure. Thank you.